Hello everyone, welcome back to B Grade Economics. This is Nate, your class leader. Let's get started. Today will be episode 3, Introduction to Major Asset Classes. We'll be going over the US stock indices, S&P 500, the Dow Jones Industrial Average, the Nasdaq 100. We'll be going over international indices as well, bond investing, fiat currencies, alternative stores of value, and their related assets. So when it comes to stocks, there's a lot of prejudice or confusion about the real value of it. Most see it as a form of casino, a place for the wealthy to take money from the poor. But it may have some of these functions occurring within it, but its base value and purpose is to become a lending source to corporations and to reward those who hold their stocks for providing liquidity so that they may actually improve their organization. So with that, we'll start with the S&P 500. This is the most common U.S. stock you'll hear about. It's a fund for a basket of investments for a single purchase. You're looking for the one asset that gets you the top 500 U.S. stocks and gives you a broad index of the entire market. So this is usually used to reference how the stock market is doing. Sometimes it's poorly correlated to how the U.S. economy is doing, and that would be a mistake. It is really just the price of the stocks or shares that are in the S&P 500 as a total sum. So it's not just a indice of how the U.S. economy is doing. It might reflect that, but it's going up or down on a day-to-day basis does not really reflect the performance of the United States as a nation. The Dow Jones Industrial Average is the top 30 U.S. industrial producers. Industrial producers are companies that produce commodities like raw materials and food, or manufactured goods that are made with those commodities, things like cars and ships, productive items. Commodities are materials needed for production of manufactured goods. Imagine like steel, copper, lumber, or corn. So things like food, coffee would be a commodity. The Dow Jones Industrial Average is those top 30. Most of those are in the S&P 500. And so they'll kind of reflect each other, but they'll have different performances based off of whether or not there's services within the S&P 500 that are going to outperform or underperform industrial average. And the industrial average obviously is affected a little bit by commodity prices as well. So this can give you a variation in the valuation of what you hold. We talked last time about the Nasdaq 100. This is the top tech stocks in the United States. We talked about kind of what's in them, like Apple and Google. This New York Stock Exchange listed fund is a different corporation fund of the top 100 U.S. technology stocks, and it was listed in 1985, so it's a little newer. As technology grew, we found that we wanted to have access to a fund of those top indexes, and sure enough, it has performed very well over time. So when we look at comparison of the three, you can see that the price history since around 1986, the Nasdaq has drastically outperformed the S&P 500 and the Dow Jones Industrial Average. And so the Nasdaq shown here is massively higher by percentage return. So even though the prices nominally may be different, the return on investment for every $100 you placed into one of these, they outperformed each other at different periods in time. And so you can see like a bubble appeared in the 1990s, late 1990s, early 2000s. We call that the dot-com boom or the dot-com bubble. That is an example of where massive outperformance is followed by temporary period of underperformance. But overall, the long term, the Nasdaq has outperformed the Dow Jones and the S&P 500. The U.S. has become progressively less into industry production, global industry production. Most of its production is for internal use. The S&P 500, as the overall the catch-all indice of these, performs a little less than the Nasdaq, but outperforms the Dow Jones in a lot of cases. So here we'll see the S&P 500 and the S&P 500 with dividends reinvested. So let's talk about why you buy a stock. When we talk about growth, a lot of times we just think about the price, but what a lot of people miscount is the benefits of dividends. And when you look at the S&P 500, when you account for the dividends reinvested, that is a massive return more than just the S&P 500 itself. And so even though the S&P 500 may have underperformed the Nasdaq over the past 20, 30 years, what we can surmise here is that since the Nasdaq provides less of a dividend, its growth has been to compensate for the lack of dividend. However, a lot of the growth in the S&P 500 is due to the dividend. And so if you were to take that dividend, the amount earned for holding the share, and put it back into the S&P 500, it would have multiplied much more than if you had just held the shares itself, taken the dividend and spent the dividend or removed it from the stock. So this is how compounding interest can be earned and increase your portfolio exponentially. And this is those doubling effects that we're looking for, this multiplicity. And so here we can see the S&P 500 index compared to some of the other top international indices. So you have the DAX, it's the German stock index in black. The blue is the S&P 500 itself. The red is the Nikkei, that's the Japanese stock market index, the top 225 in there. And then the Shenzhen Chinese stock index, I think the SZSE is supposed to be Shenzhen and Beijing exchanges, and Shanghai. And so you're looking at some of the top exchanges in China and their top stocks as well. And you can see that there's periods of time where outperformance, if you were to compare these by percentage move, the Chinese stock market has massively outperformed, mainly because it was listed as an index to be purchased globally in the early 2000s. So that price discovery and the opportunity in front of it has provided massive opportunity. At the same time, some of these stocks are correlated and uncorrelated at different times because the currency that that nation uses changes and their policies change. So that has affected the stock prices over the years differently. So you can find alternative investing opportunities through large and small nations. Some of them have big indexes like the ones listed here. So then when we talk about investing, so when we're talking about the gambling, the trading, the savings and investing kind of concepts, the stocks are effectively a much more risk-on gamble because you are investing by purchasing a share in hopes that the company either rewards you with, they will provide you a dividend, or another person will come along and purchase it at a higher price because they're hoping eventually the dividend will come around. Or they're hoping that someone else will come and purchase at a higher price. So it's a trading game. With bond investing, it's a much more solid market. However, there are still risks involved. The safest bond in the world right now is still considered to be the U.S. Bonds, U.S. Treasury notes. So the bond is a legal contract that is essentially debt. So when a company or a government offers a bond or treasury, when you purchase it from them, you're receiving back the money you purchased it for plus the interest agreed upon at the time. So what the sale of the bond was versus what the bond was worth. So if the bond is $10,000 and you buy it for $9,000, you're going to receive that 10% back over the next 10 years for a 10-year bond. So that is how you would calculate the percentage return on the bond. Bonds have a lower yield than stocks in most cases because with stocks you're getting rewarded for the risk. With bonds you're getting rewarded with an agreement that offers stability. So there's a trade-off in everything that we do here. Now we can look at the U.S. government 10-year bond yield as an example over the past 37 years, I think is what I have about here. And you can see how there's two charts here, and they're the same chart. One is inverted. It's just to show you the difference in price versus percentage return. So bonds are measured in yield, as in the percentage return you'll receive per year for purchasing it. So if I know that I give $100 to the company that has a bond, they're going to give me on agreement 1%, so $1 per year. So I'm going to get back for 10 years $11. So then I'll have $110 by the end of this 10 years. So you can see here that because the U.S. bond market is so heavily trusted and low risk, that the bond yield has actually dropped down into the single-digit percentage, and it's so low that in fact today it's about 1.6%, and it's with an absolute low of 0.03% return. Now that is a very hard yield to deal with when inflation is actually higher. So if you look at the bond yield versus the price of the bond, if the price of the bond is up, you want to be a bond holder for that period of time. If the price of the yield is going down, you want to be a seller, or you don't want to be buying right now if the bond yield is down. You want to buy when the bond yield is high, when nobody else wants bonds, and that's when your return is higher. So when we talk about bond investing, you have to think about the currencies that they're measured in. And fiat currencies are all different, but they are government mandated currencies, and the governments use both fiscal and monetary policy to manage those. And sometimes that monetary policy leads to, actually all times, that monetary policy ultimately leads to a decay in value of each of the currencies. This is mainly because there's an excess creation of these currencies in order to fund their debts. So when bond yields are lower than the inflation rate over that period of time, you have technically lost money. This is problematic, obviously, because we're here to make money, not lose money. So the DXY is commonly mistaken for an inflation measure. It's not really. It's the US dollar against other currencies. So it's a basket of them. So if it's the US dollar, against the yen, the yuan, the pound. It's multiple different currencies. So this is just an indice of how well the US dollar is performing against other currencies, not necessarily over time. So when we talk about inflation, we're talking about purchasing power. So when you talk about inflation, that is the increase in prices, which is a reflection of long-term the decreased purchasing power of a dollar. Now, these are not to be completely confused because you can have price inflation without depreciating the value of a currency. However, with a limited supply of a currency, eventually that reality would come back in other places or that value would have to come out of somewhere else. But instead, with purchasing power decretion of increasing the quantity of dollars, you have a constantly decreasing value of a currency, and therefore the value is still remaining in the assets that are going up in price. So they may go up in price, they may stay in the same value. There's fluctuations in there, but overall, the long term, you are losing money holding onto the dollar. So it's best to not use it as a store of wealth, just a form of transaction. There are periods in history where it has been an okay store of wealth, but they have usually been chaotic years, such as the Great Depression. Most other times it has been dropping in value, including the stagflation of the 1970s. You can see a massive drop off there. So I would just be cautious with saving dollars, or when you use a bond, the bond better have a yield that is higher than you expect the inflation rate to be over a period of time. So why is this money creation happening so much? Well, the U.S. monetary policy operates off of a banking system called fractional reserve lending. There's traditional fractional reserve lending imaged here, where there's a deposit with a series of reserves, and each one gets a portion of those reserves able to be held and loaned out. But the difference is that banks also create money out of thin air based off of your credit. So if I use a credit card or I take a loan out for a house, what I'm doing is I'm the first person to create money. So if the bank has $100, they can loan out, in normal fractional reserve lending, they would be able to loan out $90. In the US's multiplicity reserve lending, what you have is if I have $100, I'm able to lend out $900. I can lend out 9 times as much. And the way I do that is by creating them on a balance sheet. So when I create those dollars, they become real when you have to earn them and pay them back in, because you go out and you spend those loans, they become real into the economy, and then they come back into reserves, and then it's multiplied again. And so that creates a constant inflow of inflation. It doesn't spiral out of control just by lending, because there's a confidence in the dollar and the fact that there is a limiting factor there, and you do need the dollars to pay your taxes. So they don't exactly go off into infinity for no reason. There is some level of delay because ultimately your credit also has to be involved here, and the bank may choose not to lend to you. So there are times and limitations in where this will occur, but we are going through constant amounts of monetary increase in supply, which leads to inflation. And so this overall function and thesis of the way money works obviously downplays the purpose of savings over risk. So people like Dave Ramsey have been decried for a long time, or for more recently, for being against credit and debt. Dave Ramsey takes the moral stance that people should be avoiding debt, whereas people like Robert Kiyosaki speak on the benefits of debt, because if you're in this system, the best way to win is to leverage the fact that the dollar will be worth less later. And we see that play out in alternative stores of value. So a store of value is something that retains purchasing power over time. So obviously not the dollar, but maybe stocks are an example. Other examples are like buying a house, jewelry, used cars, and collectibles, commodities like gold and silver, or even cryptocurrencies. The purpose is to delay a purchase for a later opportunity. So you hold on to a store of value, maybe you make use of it at the time, but then traded in for a later purchase. So here's an alternative store of value we're all actually very familiar with. It's housing. So this has an alternative use because we do actually need housing, but you can rent. There's no reason to have to purchase a home when you can rent, unless purchasing a home makes more sense for you for both the benefit that it offers being a leveraged form of store of value, and you can take debt against it, and you can take debt to get one. So in this high lending environment, this makes a lot of sense to take a loan out and purchase a home. Whereas if we weren't in this high lending environment, it would make more sense to be in a renter market where you would just pay per month the value of the home. Instead, you're paying off the value of the home against leverage that comes from the bank. So you're taking out a loan for a massive portion. And this is why one of the reasons why housing, which generally holds its value, has been such a massive gainer is not only because of inflation, but that inflation directly flows into housing. And people who don't have much money take leverage out to purchase that home down the road. So that has allowed a growth opportunity, and it's a store of value. So you're kind of playing the game of how the U.S. Monetary system works in order to benefit yourself in the long haul. Other stores of value, when we talk about precious metals, we talk about limited supply. Pictured here from demonocracy.info. This website is very politicized, so I will leave that out. But it definitely is very close in accuracy from what I can surmise from measuring the history of silver and gold mining, that this is an accurate depiction of how much silver is in the world versus how much gold. Almost half of the silver produced over the entire history of mankind has been lost. We either use it in electronics today, and so therefore it's disposed of, or it's consumed in some way, shape, or form in medicines and the like. Gold has a very high recycle rate, both due to its high cost and rareness, but also it's easier to extract in the ways that we tend to use it, versus silver tends to be harder to extract in the ways we use it. So its price becomes a main reason we don't recycle it. So we're throwing away half of the silver we create, and therefore you can see that there's not actually that much in the world. Banks and everything else hold gold, and holding silver is more a private investment method, and only about half of that over time has been used as money. The rest has been used like as a store of wealth. The rest has been used for industry. And so if we look at commodities overall in the metals sector, you can see how tiny gold and silver are on the far right. They make up a very, very small portion in the world overall. Iron ore is clearly one of the most heavily mined products in the world, and it has made a massive gainer for us, as obviously we've built almost everything out of some form of use of steel. And then we can see that other metals throughout history have a massive supply as well. But you can see that there are other opportunities in here. They're not just gold and silver. You can look at other things for their ability to store value over time. And some of these do have explosive opportunities in them, so you can take advantage of these changes in valuation. Just for reference, 1 kilogram of copper would be about $10 today. 1 kilogram of silver is about $750, and 1 kilogram of gold is $57,000. And these are listed in order of size too. So the volume, the total size of the 1 kilogram weight copper bar is larger than the silver bar, and the silver bar is slightly larger than the gold bar, but they all weigh the same amount. 1 kilogram of gold would be about 2 iPhones stacked together, some of the newer large iPhones. So just for size reference of how much wealth you can store. So if I wanted to pay a bill of $10, it would make more sense to use a very small fraction of silver. If I wanted to pay a bill in a very small amount of copper, we still generally do this. We do use copper pennies, although in 1982 they were turned into mostly aluminum. But that's still just a reference point for how things have correlative values based off of their quantity available and the density at which you can store them. So this is just a nice little reference for how storing these would go and how much wealth you can place into these assets. And so over the long term, we see gold and silver have cycles play out, and you can see where when the S&P 500 or the stock market in general becomes extremely overvalued, as well as other assets we can use for comparison, but I'm using the S&P 500 right now in blue, you can see that gold and silver have spikes where the S&P 500 is less valued. So people are seeking that opportunity yield. And so we see the growth in the value of these commodities in replacement of the fact that the stock market is not yielding. And then when the stock market starts yielding again, they drop off as people move out of their stores of value back into a yielding store of value, a cash flowing store of value, something that provides a dividend. And so you can see these cycles play out, and wealth cycles are very important over your lifetime, because let's say if in 1980 you started working and you were going to work for the next 40 years, and in 2020 you were going to retire, clearly playing both sectors, the commodity sector and the S&P 500 at the right times, is much more valuable than if you had only done one. Again, we see the S&P 500, the Nasdaq, and the Dow Jones correlated or uncorrelated to gold. And so if you look at the history of bond yields and you look at these stocks, you start to see that there's a trend that emerges of fluctuation in valuation. As we've talked about before on the money supply, gold responds to that increase in money supply, and we tend to increase that money supply when the stock market or when the general economy starts to decline. And so you can see how that policy has caused surges in those prices of metals, and then people use those metals that they've saved to then reinvest back into the market, and so there's some overlap, and that is that wealth cycle playing out. Other alternative stores of value, just to talk about, like collectibles. I have watched George Gammon on YouTube. You should check his channel out at Rebel Capitalist. And George Gammon has a interesting theory on the savings and investing of money and stores of value when it comes to it being a theoretical concept. All it is a system of trust. And so when you look at the grand policies that are coming out around the world, we start to identify that there may be opportunities in things like used vehicles. When George Gammon talks about his collection of F-150s, what he's talking about is the fact that once you buy a used vehicle and it's old enough, it starts to become a classic, there will never be more of them. So that has a limited supply. The old body style of these trucks are always in high demand because that they have some fame and interest and mystique to them, as well as a sort of memory of having these when people were younger. So older people are also more willing to pay more for them. So they hold their value after a period of time. They may not go up very high, but you'll be able to sell that used truck for approximately the same or more shares of the S&P 500 if the market crashes than if you were to just keep that in cash. If you'd like to learn more about wealth cycles, Mike Maloney has a great example on YouTube he just talks about if you had switched from the S&P 500 to housing to gold and you had connected these lines in a way that moves you up faster than if you had just ridden one of these horses. And so that brings us to another alternative store of value, cryptocurrencies. Both of the people that I've spoken about, actually all of the people that I've spoken about have spoken highly of cryptocurrencies. They first are drawn to Bitcoin as a form of limited supply, mathematically derived lending system. And so we talked about some of the limitations of storing money in the forms of housing, how it's obviously one physical asset, you can't exchange it like money. And then gold, silver, and copper, the fact that they're very large and they're very hard to divide up in a way, and they take energy and consume risk. Bitcoin is a very secure network. It cannot be hacked, at least has not been so far for the past 12 years it's existed. So this provides you an opportunity to utilize a different system of trust where you're trusting a computer instead of either the physical world, you're trusting a program instead of the physical world, and a game theory on the way in which it functions. And we'll cover more on this later. There's plenty of videos out there. This is the page, bitcoin.org, where a group of people have decided to keep the white paper that explains the function of Bitcoin. And I would say give it a look just so that you can understand its core basis and why it's taking off over the past few years. You look at the price of Bitcoin over time. When we talked about risk assets like technology, Bitcoin is a technology and it's also a speculative asset. So this causes people to take a risk and then get rewarded for that risk massively as it goes through price discovery. So if you look at the lower large orange line, it's the price of Bitcoin over the past decade or so. And you can see that it's just up massively. In fact, it's up so much that for its first 5 years, we can't even really see what the price action did. So we have to put it on a logarithmic trend, and that is where it's multiples of the price of the dollar of itself. So instead of going up $1, $2, $3, $4, the scale goes up $1, $10, $100, $1,000 essentially, as just to show you the trend overall. But what we're seeing is that each one of these peaks, we're on the fourth action now of moving up. And each one of these peaks really show that there's a cycle of adoption as it gets de-risked and people are rewarded for the lack of risk that exists in it. So eventually it may become so adopted that it continuously de-risks. So this can be a form of both speculative asset and store of value. We see that it responds to money stimulus, but it also responds to technology speculation. And so this kind of creates it both a correlated and uncorrelated asset that isn't affected directly by monetary policy. So this is a new way to save money that people have come up with, but also a way to transact and share outside of the current system. And so when we talk about these alternative stores of value for cryptocurrencies, it's not just Bitcoin, there are other cryptocurrencies out there. Now, there are thousands of these. I think we're somewhere around 13,000 listed cryptocurrencies. They just keep expanding. And some may say that's a form of inflation. However, each one has its own ledger, and that's the entire point of blockchain technology, is that you can identify the difference between each one. And so Bitcoin becomes a network of people. And so when we talk about that, we start to wonder, what's the core value that's going to keep it there? Well, when you talk about Ludwig von Mises, a Austrian economist of the 20th century, his theory of regression is that a currency comes back to its core value of use. But many argue that the core value of use of, say, gold doesn't have to exist. We can have the world we have today without gold. It's extremely useful. It massively improves some of our technology, but we can have the world today without gold. So technically, gold could have zero use if we so chose to do without it. However, with the function of other cryptocurrencies, they actually try to provide some type of function use, whether it's not just store of value and transaction, but also a form of savings, investing. They can be forms of securities. They can save artwork and things like that. But there are speculative manias that follow these cycles, and we can see that the overall market cap of cryptocurrencies has really just tied in with Bitcoin's movements. Now, at the advent of the cryptocurrency alternative coin market, we can see there was a massive move. When you look at the pink, it's the other market, the rest of the cryptocurrency market without Bitcoin. We can see that it moved up drastically over the years, but it's generally stayed correlated with the overall market cap, which leads to the concern that maybe these coins overall won't outperform, and we need to limit it to the coins that are higher performing, like the top 20 or the top 50 coins that actually perform some function that will be valuable outside of just being a store of value as a competitor to Bitcoin. With these speculative assets, it becomes a concern that maybe don't treat it like a family pet. Just because it made you money before doesn't mean that it will continue to make you money. So there should always be profit taking and risk management within this. But this is a new realm in which people are interested, and it is making some people very wealthy, and for others, it's providing them sovereign safety against other risks, such as the failure of fiat currencies. If you'd like to learn more about Bitcoin itself, Safedine Ammous is an economist who talks about sound money and the progression, and shows how and why Bitcoin is very much similar to all the currencies that have existed before, and then how it's actually able to replace all of them by being a more advanced form of currency. That stated, there are issues with Bitcoin versus other currencies, and I would recommend looking at other cryptocurrencies as well. There's plenty of opinions out there, but opinions are plentiful these days. So just take a look at what matters to you and how you want to store your value and where you want to take the risk. You can watch an interview with Safedine Ammous and Mark Moss on Mark Moss's YouTube page, and it is an excellent conversation if you're more of a YouTuber and less of a book reader. And so thank you again for watching. Continue to follow along for our logarithmic progression of multiplying our wealth with our $1,000 investment. Remember, we're still looking at options calls on the Nasdaq. We'll see how that will play out. We're going to see what purchases are going to work out best for us, and then see if we can make it to that $1 million trend. I've added some things to the syllabus. Trading, savings, and investment is the episode 7 planned, and then monetary and fiscal policy and the modern monetary history are both going to be added to the syllabus in upcoming videos. Continue to follow me on Covey.io, where I manage a active simulated portfolio, so we can see how active management outperforms or underperforms the S&P 500 versus the Nasdaq with this kind of knowledge. Special thanks to Joni Sears for helping me make this video more presentable to viewers because I tend to be too much of a nerd and annoy most people that I talk to. So hopefully this will continue to improve with her help. Thanks again for watching. Have a great day.